On today's program, does unlimited liquidity, call it synthetic liquidity, from the central banks necessarily mean unlimited growth and prosperity in the asset markets, or should you have a backup plan?
The McAlvany Weekly Commentary covering monetary, economic, and geopolitical news events.
Maybe catastrophic declines are a thing of the past. Maybe we're learning to sort of manage crisis in a way that the human element is taken out and you can kind of bring sanity back into panic. The VIX staying in single digits the last year, what it implies is a brave new world. And it suggests to me that maybe keeping a little powder dry still makes some sense.
Now here are Kevin Orrick and David McAlvany.
Welcome to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany. Something that's very difficult when we're looking at rising markets. If the market doesn't seem real to us, there are ways to bet against the market. The problem is, Dave, I've watched this for 30 years now when I have bet against the market, when I've shorted the stock market because it feels like it's just a little too toppy. If my timing isn't exactly right, which, by the way, it never has been exactly right, I end up losing money in the interim. You know, that market continues to go up. Maybe it doesn't make any sense to me. Maybe it doesn't even make sense to the markets. But if the market continues to rise and you're riding a short position, you can really lose your skin.
We've taken a different approach, and that is to have that kind of short exposure managed tactically. And that means that you don't have to stick around for all of the losses. As the market continues to move higher, of course, when you have a short position, you're losing if the market is moving up.
Right, because you're betting on it going down.
That's right, and you gain if the market goes down. But in a managed tactical position, you have the ability to move your exposure, limit your exposure to nothing or to something. But it means that, for instance, here in the third quarter, we've outperformed all our peers.
Now, and when you're talking about what you're talking about is Doug Noland
and our tactical short product.
The tactical short group.
Yeah, well, this Wednesday, we have our third quarter update conference call. And for anyone who's interested in the tactical short strategy and wants to know how we executed on that this quarter, if you have questions, if you'd like to share your thoughts, this is an absolutely extraordinary market environment. And Doug's going to be sharing some of what he sees developing. And we'll look at kind of a broad range of factors from what's happening in China, an unprecedented amount of liquidity that's being created there, to what the Fed is doing and not doing in the present to create a certain bubbly environment here in the United States. But, 4:30 Eastern Standard Time Wednesday, that's October the 18th, 4:30 Eastern Standard Time, you do need to register in advance,
right? Because
there are a limited number of spots for the call.
Okay, so what we're talking about is Wednesday, October 18th. That's today at 4:30 p.m. Eastern Standard Time. How does someone register for that?
You go to the wealth management website, which is M as in McAlvany, wealth, M as in management.com. So mwealthm.com/register. On that main page, you'll see a place where you can click on and register.
And it's a great time to hear the thoughts of Doug Noland, who for decades has been the person to listen to as far as not just tactical short, but Dave, credit flow. This is probably one of the foremost experts in the world on just watching credit flow.
I went home last night and sat around the dinner table with the family and said, "Do you know how fortunate I am?" And I said, I on a Friday, I get to read Dave Burgess's comments as the wrap up, and we look at what's been happening in our MAPS portfolio strategies and the things that are taking place around the world that impact them. And on a Saturday morning, I get to read the distillation from the week from Doug Noland. And I just thought to myself, these are men that I learn from every day. These are men that I respect immensely for their professionalism and acumen. And I get to call them coworkers.
This is fantastic. Interact at any time you choose to.
No, I feel like my life is incredibly rich by the people that are in it. And so I'm grateful for that. We get to spend time with other people that we enjoy here coming up at the conferences. And as you know, we start in Overland Park on November 3rd.
Right. And so we are encouraging you, please, as the listener, try to find one of these conferences to get to. You can hear David McAlvany and Don, your father. It's a rare occasion. We haven't had that for a decade.
It's a fun dynamic. We're kind of yin and yang. we're different enough, although we share the same DNA, we're different enough that we kind of approach things in a way that complements. And so anyways, Overland Park is November 3rd. The Twin Cities up in Minnesota is November 7th. We go to Philadelphia on November 10th and then head to Charlotte, North Carolina. That's November 14th. Austin is on the 17th. So after the holidays, we'll meet up in Naples, Florida, November 28th. And then the final on this particular cycle is December 1st in Orlando, Florida.
Yeah, and we are asking you to please give us a call so that we can register you not only for the conference, but if you want to speak with David or Don McAlvany personally, you guys are staying an extra day for private consultations.
Oh, that's right. And unfortunately, Overland Park is already booked up for that, and the Twin Cities is almost already booked for that. So I would not hesitate in terms of putting that on the calendar.
Get those times booked. Now, give us a call at 800-525-9556. Okay, call us anytime and get that booked. It's well worth the effort. I traveled to 5 of the 6 conferences when you all were in the West Coast and working your way across. And frankly, I enjoyed myself more and more every conference.
We had a ball.
Oh, yeah, we really did. Okay, so Dave, we were talking about shorting the market, but I've got to tell you, we meet on Monday nights before we record this program, and I was asking you to play a game with me last night. Just say, okay, we know the markets are overvalued, but it doesn't feel like anything's ever going to change. I mean, the volatility index is just at 0 almost. Now, what I asked you to imagine for me, Dave, was what if this central banks can continue to print credit and cash and somehow feed it into the market for forever? What would be the long-term ramifications of that? And we were also talking, what are some of the other long-term secular bull markets, and how did they end?
Well, that goes back to what Richard Duncan called debtism, where we moved from capitalism to debtism, and we basically lost the free markets. And he would argue that that's an event that's already occurred.
Right.
We've already passed from a capitalist free market system, and that's the migration or evolution, if you will, that he talks about in his book, The Corruption of Capitalism.
It's no longer capitalism, it's debtism. How much can you borrow and how much can you continue to grow? And can you grow quicker than you have to pay back the debt?
And there's a real-time experiment with that in Japan. When you think about long-term secular markets, extended bull markets or extended bear markets, what comes to mind for you? For me, Japan, yes, that's there. The U.S. from 1982 to the year 2000, right. Yes, that's there as well. But for me, it's the Japanese stock market first, because here in recent weeks, we watched the Nikkei regain the 21,000 mark. So this is their publicly traded stock market. And it reached the 21,000 mark. It was last at that level 21 years ago.
Yeah, but that's only a little more than half of what it was at a few years before that. So it's never really recovered.
That's right. So 1996, it was at this level. 21 years later, it's recovered to that point. But as you mentioned, it's still 45% below its peak dating to 1989. And it's easy to forget that buying the dips, which is very popular by the pundits on CNBC and others on Wall Street, it sometimes takes not only perseverance, but the patience of Job, right, to sort of have that play out.
Yeah, but with Job, there was a recovery. Okay, now, Dave, I want to look back at what you just now said, because I've been part of these markets, so have you for a good part of them. And, it's been 30 years since we had the stock market crash in 1987. I'd like to talk about that in a little bit. But just looking at the crash in 2000 here, the NASDAQ, just in the last couple of years, got back to the level that it had crashed from in 2000. That was about a 15-year ride. But as you pointed out last week, a lot of the stocks that represent the NASDAQ, they're new. The ones that actually crashed, a lot of them never came back, and a lot of them are out of business.
Well, right. So, I think you can still look at those hot stocks, those hot areas of speculation.
Right.
And on the other side of a peak, they may smolder and barely send up a thin tendril of smoke for decades to come,
okay,
as we saw with the Japanese market.
Okay, but there are plenty of books on how to analyze a company and say, all right, well, is this well managed? Is it going to actually earn not just revenue, but profit? You talked about revenues and profits last week and how you can mess with what profit is for a little while with little fancy accounting tricks. But revenue and profit has always been the reason why a person goes into business. But at this point, it doesn't seem to matter. At this this point, it's just how much can you borrow and can you get something built before you have to pay the debt back?
Well, that's right, because the fundamentals review, whether that includes demographic growth or an improvement in company management, acquisitions which are accretive to the shareholder, that was the question asked. What was the backdrop driving economic growth? Mm-hmm. It's not the case today. It's more of a proximity question, and it's proximity to free money. It's the ripple effects of central bank asset purchases, which are more of the defining elements at present. So,
do you know Janet Yellen? Do you know Mario Draghi? How close are you? How close can you rub shoulders and get that free money?
So it may be that as we watch the markets over the next few years, look, Japanese equities may continue to bubble higher. Mm-hmm. Why? Well, it's quantitative easing. It's artificial buying from the Bank of Japan. Bank of Japan now owns roughly 75% of all Japanese ETFs. It's fascinating. And it's unlikely to change so long as it's politics as usual in Japan. Right. Get close to the flow might be the 21st century mantra for investing. And in Europe, too, this is the case. The ECB has said that QE is going to be further reduced, yet Draghi's dragging his feet. Sure. Why? He's looking at inflation stats and is not happy yet, and he wants to keep still the foot on the gas. So Europe has now had several years of improving economic numbers, but the central bank community is in love with an inflation concept, which says, not yet, not yet, not yet. Not until we get our inflation number back to normal will we reduce our quantitative easing.
Well, we talked about that last night. Sometimes you can focus so intently on one thing that you can ruin everything else in your life, okay? You can literally die on a hill and lose your family in the doing. And in a way, focusing just on the inflation number, when we have these asset prices that are they're going through the ceiling, Dave, and it's not because of profitability. They're just going through the ceiling because the money is available while they wait for this inflation number to hit whatever level they say they need it at.
What's very uncomfortable about this whole equation is we're talking about two dysfunctional geographies, both Europe and Japan. And we're talking about geographies that are seeing an implosion from a demographics perspective. Right. Yet the preferred question today is not one of economic growth and its backdrop. It's what is the backdrop for positive price action? Mm-hmm. And so as we are living in a world of excessive credit creation, everything becomes a speculation.
Well, and right now, everything is a bull market. It's a speculation, but look at the front of The Economist magazine last week. It said everything is a bull market. Now, why is that, Dave? It's because money's free.
The VIX, as we've noted before, is a picture of the crowd.
That's the volatility index.
Yeah, and they're anticipation of negative change in the market. So what do they see on the horizon as something that will change the trend of growth? And I frame it that way because we have had plenty of volatility. Right?
Only one direction.
It's the kind of volatility that investors like. Prices are going up. It's the negative volatility that has investors concerned and engaged in hedging, which would show up in the volatility index, the VIX. When the number is low, it's said to signify a broad-based complacency.
Well, last week you told me that you could actually short the VIX. Okay, you could sell short the VIX and say, people are just going to grow calmer and more complacent. That's an amazing way to make money, is to bet that everybody's just going to go to sleep.
Right. Well, and actually that's a huge bet at present. I mean, we have today what is a raging bull market in complacency.
Right. How often have we been this low on the volatility index?
Ed Easterling wrote some of this. John Malden pointed it out recently. Ed Easterling's observation on the VIX was that the number has only been below 10 on its index 41 times since 1990. 41 times since 1990. 32 of those times have been this year.
Wow.
And 15 of them have been in the last 30 days.
I think it's important to point out, anytime the volatility index gets this low, it always signals a change is in the wind. It's just they've been able to delay it this year.
Right. So abnormal is either the new normal or we're on the cusp of real change in the marketplace. And I would guess that change is unpleasant.
Dave, one of my favorite times of year is this time of year, especially as I drive into the office over the Animas River and look down at the beautiful changing leaves. And, something would be wrong if it were this time of year and those leaves were anything but yellow and orange. If those leaves were still green and they stayed green through November and then December and then January, that would kill the tree. Ultimately, we need that change. We need those leaves to drop off.
I remember coming home from work one day from Morgan Stanley, and Mary Catherine was crying. And you have to understand, I thought somebody was dead because she's tough as nails, and I very rarely see her cry. And I just, what's wrong? And she said, well, it's always summer in Southern California, and I miss the leaves changing. There's something that's missing from our life, and there is nothing in nature that marks the change and progress of time. And it just leaves me incredibly melancholy and missing the East Coast. And right now it's Boston, and the leaves are changing, and I'm not there.
Sure, she's used to 4 solid seasons, and actually the markets have to have the same thing.
Well, my interest in change is more than sort of that seasonal fancy. I love it when leaves are turning. Right. I love it. This is my favorite time of the year. But it's more than that, because when you look at change, there is regeneration, there's renewal, there's life that comes out of winter. I mean, what do you have in winter? You have darker days, you have shorter days, and a period of rest, and everything needs it.
Right. Well, you put that 10 pounds on too. I mean, that's anyway, you're right.
Not true. This year, my training cycle begins in December. So we've got a race in June for anyone interested. There's a half Ironman coming up in Coeur d'Alene, June 24th. Join us. Be there, be square. That was for you, Kevin.
Oh,
Love for you to join me in the race. But if volatility is dead, do you know what also is dead? The market is dead, because you basically have no way of gaining an appreciation of price. There's no price discovery. That would be a sad state of affairs. For the time being, I think we operate on the assumption that we're just dealing with something that's on leave, on vacation. And volatility, even though it's gone at present, it will return shortly.
Well, and we talked about it being a bull market and everything. The one thing that's been completely ignored, like we have said in the past, gold has been up, between 10 and 13% here for the year.
Silver, 9% to very little fanfare. And it's funny, my 8-year-old buys with ferocity every chance he gets. And price is not really in the equation. Of course, part of the reason he doesn't care about price is he gets kind of a 2-for-1 special. I motivate or incent savings in silver terms by matching his purchases.
Dave, if you only did that for our clients, I mean, it would just probably double our business.
And bankrupt the company at the same time. But my 8-year-old, again, I mean, he talks about his long-term ounces. And this is kind of a fascinating new conversation of late.
What 8-year-old thinks long-term?
These are the ones that he wants to keep forever as sort of a foundational holding.
Yeah.
And then there are those that he wants to turn into other things. And he is kind of our budding entrepreneur in the family. It's wonderful to watch in the gold and silver market what is a stealth bull market.
Right.
Nobody cares. Prices are moving, again, 8, 10, 12%. But nobody cares and nobody observes that when they're in the shadow of Bitcoin or Facebook or Amazon or the biotechs, now up almost 29% year to date. And the metal to watch, frankly, if you were just looking at value, I think this was 2 or 3 weeks ago I mentioned this, but I'm intrigued by platinum.
Sure.
I'm intrigued by platinum because of the ratio to gold, the discount to gold, and the ratio to palladium. And I think if someone has sort of a 3-year time horizon, an intermediate horizon, you can play that platinum palladium ratio for a big gain in ounces. I think it's worth it. If you don't understand ratios, I think being in touch with our team would be well worth the time.
Could I just take a moment and just tell a story from yesterday, Dave? Because I have a client who I was talking to about his required minimum distribution in his IRA. We had positioned him in palladium because it was the better buy about 8 years ago. And he knew that at some point we were going to turn that palladium into 2 or 3 times the platinum just by taking the palladium side first and then moving to platinum. Yesterday, we tripled his platinum. He was thrilled, okay? This is a man who has been waiting patiently, and he understands the concept. You know what he was thrilled about? He wasn't thrilled about triple the platinum. He got 3 times the ounces in platinum. No, he's like your 8-year-old. He's looking long term and he says, you know what? Let's triple the palladium. So he's waiting to now triple again. Yeah, he understood the concept. And this is not a hard concept, but it does require some experience. And I would, like you said, encourage anyone who's interested in this, call us and we'll show you how to do it.
No, I'm proud of our team. I think unlocking value and exponentially growing ounces is possible if we're engaged in that level. And we'd love to be. So, I mean, don't get me wrong. I think any position in the metals is interesting,
right.
But when you properly allocate and diversify in advance, some of those ratios can play to your favor over time, which significantly improves your total returns.
Dave, this is a memorable year for me because it is the 30th year of the crash of 1987. But I remember
the first year you came on board with this.
That was the first year that I started here. But I remember the market for the next 9 years rallying to the point where Greenspan, and he was partially responsible for this, but he said, the markets are getting irrationally exuberant. I remember calling my clients and saying, hey, Greenspan thinks it's about to crash. It didn't. 96 came and went. 97, the market got higher. 98, 99, we know what the tech stock boom was. Now, 2000 ultimately did come, and irrational exuberance did hand people back their heads, okay? But Yellen, look at what Yellen has said over the last few months about Facebook and Amazon and some of the social media stocks, biotechs. She says that they may be overvalued.
We quoted her last week as saying that in her lifetime, she didn't think we'd see a correction in the stock market. Right. Which, has a ring of Irving Fisher. We've reached that permanent plateau in price, said 1929, just months before the market crashed. But Yellen's concern about overvaluation with social media stocks and biotechs, that was not this year. She was talking about that back in 2014.
Oh, I thought it was just in the last few months.
No.
She's been talking about it for a while.
Right. No. If you go back to 2014, she was saying, look, things are a little hot and heavy in the biotech and social media space. And now you've got biotech almost 90% improved since then, up in value. And social media has moved up in price 70% since that. And you're right. It is like Greenspan's observation in 96.
Yeah.
Markets were irrationally exuberant. He was right. They doubled again from those levels anyway. And that's the nature of speculative markets.
Sure.
They reach irrational levels, unimaginable to most investors, and then they double again. And I suspect we are closing in on the end of that cycle where irrational levels were identified 3 years ago. And now we've just about doubled in price from what was considered an irrational level. And I'm fascinated to see what happens next. You've got technical analysts which point to things like, a rising wedge in the S&P 500. And you look at a chart like that and it either breaks down and the price begins a long correction, or it breaks out and breaks it to the upside.
It's been breaking to the upside.
It has. So it's resolving itself positively. In the context of the equity markets being already overbought. Mm-hmm. And this breakout to the upside may just ring the bell. We've got new highs in all the indices. The industrial average, the transportation average, the utilities average, the Russell 2000, the S&P 500, the NASDAQ 100. And what it really suggests is that there's very little differentiation in the purchases. Just buy the market in whatever form.
Just buy anything.
And it was interesting. This is kind of a word of caution going back to CNBC. When you are at all-time highs, and CNBC comments as they did this last week. We had one day where a couple of bank stocks were off 1% to 2%, had a decline. And, so financials and bank stocks are off, just barely off of their highs. And CNBC commentators come in and say, oh, you got to buy that dip. Look, this looks like a value opportunity. And I just think this is the kind of lost perspective that you have at the top of a market.
Well, and people would ask, I remember hearing your dad tell people over and over and over through the decades when things got high, he'd say, guys, keep your powder dry. Now, that's an old comment about muskets and keeping the powder dry, but I have one of those muskets, and you have to have dry powder. If you have any moisture in that powder, you have to throw it out. It's done. And what we're talking about, and what he was talking about on keeping your powder dry, is you can either spend your powder right now on something that's making money and not have anything when the thing reverses, or you can keep your powder dry, stay liquid, because something is coming. A repricing is coming.
Yeah, I've read a couple of asset managers who have retired in recent years, so they no longer are subject to the pressures of client asset management, and it's just managing their own money. And pretty consistently, the guys who are just managing their own money, moving to 25, 30, the highest allocation to cash I've seen is 60%. But they're
older managers.
And they're not playing the game where they have to keep up with the Joneses, as in, the index or whatever. They're now just saying, on a risk-reward basis, should I be here? And to me, one of the rarest commodities on the planet today is dry powder. Mm-hmm. Rarer by the day, which is in fact why bear markets often get so nasty. There's no one to support the price when everyone is in. You get cash and liquidity levels, which we mentioned here in recent weeks, that suggest nearly everyone is in. The B of A numbers and the Merrill Lynch numbers, JP Morgan's numbers, looking at client cash allocations, and then reflecting on percentage allocations to equities. Very, very historically high. So technically speaking, there are these interesting patterns emerging in the indices. Not only do you have the rising wedge where, we've seen a breakout to the upside. That's positive. And if you're looking at Dow theory, a confirmation of a bull market with the transports supporting the industrials to higher levels. But it is interesting because we're also seeing small indications, new highs on a given day and closes well off the peak of trading levels by the end of that day. And to any technical analyst, that's troubling. You'd much rather see strength on display than sort of a tepid probing of the market's outer bounds. And that's what it looks like. Tepid probings of the market's outer bounds is not actually confidence and a massive influx, which is saying, prices be damned, I'm going in.
Okay, but let me ask the question that a lot of people are listening here and saying, you know what, Dave, I sold my stocks. I get it. I'm out. I'm in cash. I'm keeping my powder dry. Why should I worry if other people, like my neighbors, are out buying stocks? I mean, how will that affect me if I'm not owning stocks?
Yeah, Ned Davis has a research company and asks a similar question. Why should your neighbor stock buying worry you? The answer is U.S. household equity ownership is near record levels. The only higher period was at the top of the market, 1990s internet bubble, and at the top of the market in 2007. So what do we have today? If you're watching your neighbors, it's another lemmings parade. I mean, everybody's in, and percentage ownership of equities in terms of net worth, again, you're ringing the bell in terms of what people do at the end of a cycle.
One of the foremost experts at valuation of stocks and one of the better stock buyers through the years is a guest of ours. We've had him on several times, and you actually flew out to Scotland to meet with him, Andrew Smithers. Andrew Smithers looks at several things, Q ratio, but the Shiller PE is one of the key instruments on his flight panel that he looks at, and he says, you know what? I know when it's getting overvalued. And the Shiller PE right now is signaling that there's a problem.
Yeah, it was interesting. Both he and his co-author, I can't remember his name, but they were both professors at the University of Edinburgh class that I took. And, they looked at a variety of things. The cyclically adjusted price earnings ratio, which was popularized 20, 30 years ago by Robert Shiller. And so they call it the Shiller PE as well. So the Shiller PE or CAPE, that according to Andrew Smithers is the best way of valuing stocks, next to another ratio, which he discusses in his book called the Q ratio. And so again, you've got a 10-year rolling averages of price and earnings, which is the CAPE. And what has it done? It's just surpassed 1929 levels.
Right.
In his book, Valuing Wall Street, he proves the value of these two measures above all other market metrics and looks at all market metrics and basically gives you the data about how accurate they are in terms of giving you some sort of predictive insight into the market. Now, he's not looking at it as a timing mechanism for trading stocks on a day-by-day basis.
Right.
But if you're saying, where are we at in the seasons? Is this a season of growth and renewal, or is this a season where we're going to see decay, destruction, death, and really just, something that, look, it's the beauty of bear markets is that they are the precursor to bull markets.
Well, and sometimes you have to wait. I remember that conversation that you had. I listened to the recording, Dave, with the harp music playing in the background when you were sitting in Scotland, talking to him and interviewing him. And he told you, he said, you know what? The stock market may have further to go up. Now, this was a couple of years ago, so it did. The stock market continued to go up. But he said, the downside risk, I'm an older man. The downside risk is not worth it to me. I've moved to cash. Now, this is one of the foremost stock valuation guys in the world, and he says, I've moved to cash.
By the way, he wrote the book Valuing Wall Street, and it's a must-read for any student of market history.
Right.
He wrote it, published it in 1999, and was making the case that between CAPE, or the Shiller PE, and the Q ratio, that these were irrefutable evidence that there in 1999, they were at a market peak, and that we would have subpar returns over the next decade. And lo and behold, gold does well for the next 10 to 12 years, while stocks suffer for the next 10 to 12 years, and he was exactly right. You had a low rate of return environment for equity investors and a high rate of return for gold investors in that period of time.
Well, isn't the Shiller PE higher now than it was even in 1999 when he sounded that warning?
No, in fact, 1999 was its all-time high.
So what are we worried about?
44 is what it was then. 31 is what it is now.
Right.
31 far exceeds any of the other bull market phases that we've seen in the last 100 years, the exception being 1929. Again, 1920s, the roaring 20s, massive speculative boom, followed by a massive bust. And we got to about 30. We're past that now. We're past the numbers that we saw in 2007.
So before every other crash, we're higher than what we were, except for 1999.
Well, and part of that is because of the way earnings blew out in 1999. Price continued in its speculative blow-off phase late 98 and early 99, and earnings had already begun to recede.
Right.
So you had this strange snap where overnight, boom, the price earnings number goes up, and that gets factored into that 10-year average. So the implication is pretty significant, because just as Andrew Smithers would have said, I don't like a post-99 world, which is why he wrote the book then.
Right.
And why on our commentary just a few years back, he said, I don't like this market. It's too expensive. And at the time, he said, basically, I could expect less than a 2% return. If I recall, the cyclically adjusted price earnings ratio when he was on our program was closer to 26. So now it's 31. What has changed? And this is really the implication. It implies that we have a decade of average returns in equities at right about zero. You still have a whisker's breadth to the positive, but we're talking about basically zero returns for the next 10 years for the equity investor.
So, Mr. Jones, go ahead and take a risk in the stock market and expect zero return. But the mainstream media, they see no bubble. I mean, they're there for entertainment, first and foremost. But the financial media, they're talking about this not being a bubble and that this could continue to go for many years.
It's interesting because if you look at the global stock markets, add them all up, the combined capitalization of the world stock markets is right around $87 trillion. We tacked on an extra $2 trillion last week.
Wow. What is global GDP? I mean, what is that in comparison to what we actually create?
It's not 87 trillion. So again, you've got the prices of a speculative vehicle exceeding what you have in terms of the productive engine, if you will. And so again, you look at the global stock aggregates of 87 trillion compared to global GDP, and you come up with about 111% ratio. That is a bubble. And why do I say that? Because that ratio has never been higher. Not 1999, not 1929, not 2007, not 1968. I mean, pick any period where the stock market was peaking relative to the economy, both here domestically in the United States and globally. This number's never been higher. Yet the mainstream media folks, as you say, they see no bubble.
Well, let me ask you a question, okay? Because day before yesterday, it was interesting. Gold just all of a sudden dropped $10 or $12 based on the fact that they brought up a guest of ours in the news, a guy named John Taylor, who believes in the Taylor rule, which, the thought would be that he would keep interest rates at a certain percentage higher than what the inflation is. And of course, gold started to come down. But one of the things that's fueling this market is the expectation that interest rates will stay low. Now they're looking, Trump is interviewing different guys. You've got Warsh and Taylor and Powell, and these guys bring something different to the table. But I thought back to one of our guests, Dave, who was in the Reagan administration the first couple of years. And he said, we hated Paul Volcker. Reagan would have never picked Paul Volcker knowing what he was going to do, which was raising interest rates to the degree that he did. Do you think that someone in the Federal Reserve will step in and possibly pull a Volcker like a John Taylor?
Well, you've got Warsh, you've got Taylor, you've got Powell. And I mean, there's a few other people interviewed. I think Yellen has been through the interview process as well. But these are, the explorations for the next Fed chief. And it's all very interesting. Taylor, as you know, has been a guest on our commentary before. And frankly, in my opinion, he's the least likely to be appointed.
Because they don't want to see interest rates rise? Is that what you're thinking?
According to the Taylor rule, which he popularized, developed from his post there at Stanford, it applies that the Fed funds rate should be north of 3.5%. I think it's 3.75% right now. And what that means is that markets would be very unhappy.
Right.
If he was brought in, the implication is if he applies the Taylor rule, that's really going to change the rate structure and change asset pricing as we know it. So speculators would not like it. When I say markets, what I really mean is speculators would not like that.
But let's face it, that's what we need. I mean, Volcker brought in what was needed at the time. We had high inflation back in 79, 80, 81.
Even if the experience of it was not enjoyable, you're right, it's what we needed. Now, Powell has establishment sponsorship and is the least likely to rock the boat. Warsh is a Fed QE critic. He was not a fan of QE 1, 2, or 3. So again, I mean, Taylor likes rules, his own included, which again, doesn't really fit the community today, the central bank community, which is an ad hoc world of accommodation and money printing. And it leaves Taylor and Warsh to a certain degree outside the acceptable envelope.
Well, and could it not be political suicide for a Trump to come in and say, hey, I'm going to put somebody in who is going to raise rates? I mean, look at his reaction when he was told to trim Medicare and Social Security. I mean, that wasn't even on the table.
No, that's right. We think of Republicans generally, well, some of us, some people out there, how should I say this? Some people out there think that Republicans are fiscally conservative.
Years ago, maybe that was true.
Please introduce me to one, and that would be helpful. That would be like a field trip. We could look at the monkeys in the cage, and here is a Republican who believes in fiscal conservatism.
I think Jesse Helms was a fiscal conservative. Now, he's been gone for many years.
Right. But the Office of Management and Budget, McAlvany, advised Trump this last week, look, this is not going to work. You got to trim Medicare benefits. You've got to trim Social Security. We'll probably see a 2% bump in Social Security payments. So, we're moving the opposite direction. Trump did not take his advice, did not like his advice. What's the implication? The implication is we're heading for a fiscal blowout. We've got rising costs. That's healthcare and actual living costs on the rise. We've got increased demand for services, which is a demographic-driven thing with the boomers retiring in one mass glut. You've got shrinking demographics to support the payouts.
Well, let's talk about shrinking demographics, because we're told that we have very, very low unemployment, yet 1 in 3, almost 1 in 3 people, if you got everybody out standing, did, let's say, the line across America like we did before, 1 in 3 would be unemployed.
Well, this is where the NILF matters. The not in the labor force number is nearly 95 million. Not in the labor force. That's 25 to 30% of the population is not in the labor force. So it's the issue in the end is that debts will rise.
Right.
And that Trump is no different than the Republicans that precede him, is no different than the Democrats that preceded him. Debt is the problem. And it rings of our conversations with Bill King's, where he constantly says, it's the debt, stupid.
Right.
When you think about central bank commitment to inflation metrics, again, why do they want 2%? Why do they have to have 2%? Why are they fixated like a dog with a bone? Why will they not let go of that 2%? We've got Draghi overseas, who's probably willing. I mean, just here in the next couple of weeks, I think it's the 26th or 28th of this month, he'll let us know if he's going to continue the QE program in Europe. What is he holding out for?
Oh, I'm waiting with
higher
my bated breath.
Inflation rates.
Yeah.
Why is it important? It's because we already have too much debt, and we're on the way to adding more on top of it. The only way to manage your debt burden is the twin approach of inflationary pressure reduction. That is, inflate it away, pay it off with cheaper and cheaper dollars, and control the rates that you're paying on that debt by suppressing interest rate levels as they have effectively done, what we call repression.
Okay. Well, I brought up Reagan. I'm thinking back, I'm starting to go back and get a little nostalgic, Dave, because it is my 30th year here. But that first year that I was here, it was a great learning experience. As painful as it was for people, it was a great learning experience for me, because on October 19th, we're coming up on this, 1987, we had a very black day. And I remember we were sitting in a meeting. I mean, we looked at the stock market. It was crazy. And Don said, well, we're still going to have the company meeting. So we sat for an hour and a half and had a normal company meeting while the stock market fell hundreds and hundreds of points. And a lot of those companies never recovered.
Yeah, over 500 points. It was interesting. It's one day, Thursday and Friday the week before were pretty rocky. So leading into it, on the weekend, they had time to kind of fester. And then in Europe and the Asian markets, things were looking pretty nasty too.
Back then, it was about 20% of the market, though. I mean, 500 points was nothing to sneeze at.
No, that was over 20% down in one day.
Yeah.
What you had was the collapse of portfolio insurance. What that was is a derivative construct meant to reduce portfolio risk.
Well, remember Richard Bookstubber. I mean, he was part of the design of that.
That's right. And his famous what were to me, famous words in his book, The Demon of Our Own Design, where he says, I might not have been responsible, but I was right there. And
and he's a regular guest.
That's right. So what they ended up doing, instead of reducing portfolio risk, they exaggerated it instead.
Yeah.
And so, I mean, this week we think of Bookstaber. Today, it's a little different. We don't have the same kind of portfolio insurance, but we do have a massive amount of money being managed according to quantitative and rules-based systems, which are now all the rage.
Well, and back then it was billions of dollars. Now it's trillions of dollars.
That's right. I mean, you would have sort of the pig in the pipeline proverbially if you had, 3, 4, 5, 10, $16 billion coming through of a particular product and no one to buy on the other side. Now we've got $3.933 trillion in assets in this sort of quantitative rules-based systems. This includes your quant hedge funds and your ETFs, all of which are in that rules-based category. The problem here is you've got assumptions layered upon assumptions, which in a nanosecond world of trading triggered off of news feeds. I mean, I think more in the public consciousness today is this idea of fake news.
Yeah.
Well, what about news and the headlines being the determining factors of how algorithms trade, either buying or selling? And this is stuff that we make up. It doesn't have to reflect reality. This is the creativity of an editorial board.
And the editorial board might not even be an editorial board. It might be an algorithm itself. These algorithms literally write stories. Dave, Bloomberg, I remember when it was announced, I was in New York City when I heard that Bloomberg, which is the news franchise, actually was creating the algorithms and selling to Wall Street the algorithms that trade on the news stories. What a world. What a world when you can create the news and profit on the news stories using the key words that are built into the program. Unbelievable.
I know, and it's all in real time. But the crash, again, 30 years ago, 22% in one day, it left its mark 30 years ago this week.
Right.
Frankly, if you're new to the market, not much is remembered, which is why we do find cycles repeated through time. Differences between now and then. Yes, the proliferation of derivatives has been huge. What was sort of a market in its infancy and what they called portfolio insurance, now we have so many more kinds of derivatives out there. And, there is lingering concerns, even after 2008 and 2009 and the global financial crisis, over high levels of institutional risk that remain even if you have offloaded that risk onto someone else in the broader market. But what has happened, though, is derivatives become the opportunity to offload risk and take on more leverage. So you feel like you don't have as much risk on any single bet, but in aggregate, not only do you have more risk, but the whole system does too. So what derivatives have served to do is provide an excuse for leveraging beyond numbers that you can imagine.
Okay, but there have been changes through the years. Sometimes it's a small technical change that's mathematically you'd go, well, why would that make a difference? You remember they used to trade stocks in fractions.
Right.
In fact, I think when you first started as a stockbroker,
that's right,
they would trade in fractions. And then they changed that to decimals. And that actually caused convulsions in the market.
We're talking about big shifts in terms of derivatives, but the smallest shifts are in the end, maybe some of the biggest. This is what I would look at as sort of a two-part devolution for market makers.
Right.
We've been restructuring the role that a market maker plays since 2001. And you're right, the first would be the move from fractions to pennies. That's the decimalization of shares, where you used to be able to buy a stock and it was quoted at $32 and a quarter, or $32 and an eighth, or $32, whatever it was a fraction instead of a decimal. And that decimalization basically gutted market makers starting in 2001 from what had been a healthy margin. It crushed transaction costs. It began to squeeze the margins for market makers and disincentivize people playing in that role in the market, facilitating liquidity.
Well, Dave, just to give a person an analogy who doesn't follow this very closely, the difference between turning it to decimalization, you could go as many spaces behind that decimal as you wanted, whereas the fraction, it kept the trades within some sort of a workable boundary.
Yeah. And, so that was the first crushing of the market makers. Now you've got the Volcker rule, which Bookstaber talked about when he was on our program.
That de-incentivizes anybody to buy stocks, the big market makers.
That's right. They solved the problem in terms of, creating an alignment between clients and the folks who are holding assets for them. But one of the things that they crushed was the incentive for market makers to hold an inventory. So the Volcker rule further guts the market maker. And this is, I think, a very curious market evolution, or as I mentioned, maybe devolution.
Right.
Here are the implications that I see. During the last decade, we've been in the process of distributing shares to investors. Meanwhile, the plumbing on the street has been shifted to accommodate more of a unidirectional flow of distribution.
Think about it from your house's perspective. If water only flowed in and you had no way of flushing,
that could be a problem.
That could be a problem. And flushing would be the liquidity side of things. all markets have to have a buyer at some point. In fact, we try to drive that into our clients' heads. It's like, no, don't just think about when you're buying gold. Where are you going to sell it, and when do you want to sell it?
Yeah, so there is buying and selling which occurs every day. I'm not suggesting there's not liquidity today, but it's more the question of when trades cannot be matched up, who's willing to step in and hold an inventory? And the incentive to do so has been destroyed through decimalization and the Volcker rule.
Well, and automation.
And what it suggests is that you don't have the kind of liquidity that you might have assumed in earlier generations. Because we haven't had many downside tests, we really don't know what happens next. We got rid of the uptick rule, which was one of the things that sort of slowed the downward progress in a market decline. Maybe we replaced it with something that was as good or better. Depends on your perspective, I guess. But we do have, kill switches along the way, circuit breakers, which will halt trading at a 7, a 13, and a 20% decline.
Right.
But, again, we've got these factor and rule-based automated management systems, which are now in control of just shy of $4 trillion in assets.
Call it a robot.
And that number's climbing. But you take your risk parity models as an example. This is a very popular way of managing money using a combination of fixed income and equities and leverage. And low volatility, going back to what we talked about earlier with the VIX, low volatility in the market translates into a broader asset base for the strategy because they can leverage up in a low volatility environment, and that raises the level of assets that they have purchased for their portfolios.
Okay, but what happens on the other side when people are actually selling, not accumulating?
Play that in reverse. If you have an increase in volatility, it leads to a required rules-based reduction in assets in order to scale back balance sheet leverage. Mm-hmm. Now, not on a whim, but we're talking about a rule forced selling occurs in that environment, and it's all handled by computers and code.
Right. And
sometimes that automatic forced selling gets out of hand. We've had these unexplained flash crashes which have happened in recent years, and they're happening with greater frequency and severity.
Yeah, we've been talking about volatility being close to zero, but every once in a while you have this flash crash that just occurs and nobody can, they'll say, well, it was a fat finger. I had a good friend, actually, he's not in the brokerage industry, but he was trading their entire retirement and he got wiped out. A big part of his gains, years of gains, were wiped out in a flash crash that occurred back in 2010. And he looked at me and he goes, you know what? There was no reason for that to occur. I just lost everything.
Right. Well, and it's happening with greater frequency and severity in part because of these forced selling rules. Again, it's factor-based. It's rules-based automated management, which is, I think, going to, in the end, exaggerate some of the price declines that we have in the future. But it's not as if we haven't had a forecast or preview of things to come. August of 2007, there was an implosion in quant funds, Renaissance Technologies being one of those quantitative funds. Goldman Sachs was also a big loser. We're talking about, 9 to 20% losses. I mean, those are big losses in a very condensed period of time.
Well, and if you're leveraged, it can be everything.
You mentioned May of 2010. I think that might have been on the 6th of the month, if I remember correctly. The market dropped 7%, and it did that in 30 minutes.
Right.
Why? Nobody knows.
Yeah.
But you had bids on shares that were selling for $10, $20, $30. You had bids at a penny. And you had the ask price for many of those same shares at $10,000 to $100,000 per share. Something went haywire. It was like temporary insanity. It was like literal wires had been crossed. Again, August 24th, 2015, The Dow opened up. 5 minutes later, it's down to 1,100 points.
Right.
1,100 points in 5 minutes. Most recently, I think of the Brazilian stock market. Again, people love these exchange-traded funds, but on the day, the Brazilian stock market traded 19% down in one day. Closed, I think, down only 16%. But that was driven by ETF liquidations. Now we have massive strategies that benefit from low volatility and, in fact, load up on leverage when volatility is low.
With the assumption that it will never, ever get higher.
Yeah. And it implies, as we mentioned with risk parity, shrinkage of portfolio holdings to eliminate leverage when volatility returns, right? So if you're looking at things the way they are, just recognize that's not the way they stay, because volatility, unless it's dead, means that there is a massive shift that occurs, and forced selling is a part of that.
Okay, so the Korean missiles flew over Japan. People called and they said, how come the markets aren't reacting at all?
This is what drives you crazy. It drives you crazy because there's no explanation for the moves that we just talked about, but there's also no explanation for news that would ordinarily drive higher levels of volatility. North Korea, hello. Does that matter? Turkey is making closer and closer alliances with Iran and Russia. The market does nothing.
Right.
And frankly, it's absurd. The Korean Peninsula is, as we speak, practicing war games. North Korea, in just the last 10, 20 days, has hacked the South Korean military installations and attained South Korean countermeasures to a North Korean attack. And who cares? Nobody cares. Nobody cares. And that's what you get when you have a central bank controlled universe.
Right.
You get the South Korean stock exchange, which is up 22% year to date. South Korean stocks shake it off as if the brink of war was a total fiction. It's amazing.
Well, I'll never forget 1987. I was eager to learn anything I could, being my first year, and I remember getting the August issue of Fortune magazine, and it said, "Are stocks too high?" And it said, "Nope, new methods of valuation say that they can continue much higher." Now, it was 6 weeks later that the stock market just cratered.
New methods of valuation, I mean, that's like straight out of the Bureau of Labor Statistics, the Bureau of Economic Analysis.
This time it's different.
Yeah. Well,
yeah.
Our market crashed 20% in October of 87. What people forget is that it doesn't always help to be diversified across geographies. Japanese stock futures were down 50% at the same time. Taiwan, South Korea, and Hong Kong exchanges were down nearly 50% as well. So, I mean, does going international reduce your risk? Really? Probably it does not. But I think that is a popular ploy to keep people in the markets. Shift your geography. And I agree that from a valuation perspective, emerging markets are cheaper, but sometimes cheap gets cheaper still. And now we have, as I mentioned a minute ago, circuit breakers which exist, which will shut the market down. Trade halts, which come in at 7%, at 13%, at 20% declines. Uptick rule went away, I think, in 2007. So maybe catastrophic declines are a thing of the past. Maybe we're learning to sort of manage crisis in a way that the human element, the human factor is taken out, and you can kind of bring sanity back into panic. The VIX staying in single digits the last year, and as we mentioned earlier, 15 times in the last month, getting below 10. So over the last 30 days, what it implies is a brave new world. And I'm open to things changing. I'm open to the idea that perhaps there is progress on Wall Street and in the world of structured finance, but it remains to be seen how much bravery we'll need in this new world of ours. And it suggests to me that maybe keeping a little powder dry still makes some sense.
You've been listening to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany. You can find us at McAlvany.com. Be sure and call us also to make your reservation for one of the upcoming conferences over the next few weeks. Call us at 800-525-9556.
This has been the McAlvany Weekly Commentary. The views expressed should not be considered to be a solicitation or a recommendation for your investment portfolio. You should consult a professional financial advisor to assess your suitability for risk and investment. Join us again next week for a new edition of the McAlvany Weekly Commentary.